The broadcast is now starting. All attendees are in listen-only mode.
Something overwhelming. Good morning and welcome to the webinar. Thank you for joining us today. We will take you through the changing transfer pricing landscape in India and discuss the impact of relevant developments on German MNCs operating in India and the critical issues that persist. Transfer pricing is one single area that has been generating heat over its 16 years in India. The environment around the Indian transfer pricing regime has been considered to be one of the most aggressive in the world, with a spate of litigation. A series of measures have been taken by the government to remedy this image and resolve the tax disputes as well as align itself to the global best practices. The purpose of this webinar is to take you through the various legislative changes, measures taken by the Indian government, and issues that still persist, which are particularly relevant to German MNCs. We have with us today Maulik Doshi, who will share his insights on this topic and explain the implications it would have on German MNCs operating in India. Maulik heads the transfer pricing practice at SKP and has over 14 years of experience in cross-border tax and transfer pricing. Maulik advises multinational corporations on Indian and foreign transfer pricing rules in all contexts, including planning, litigation, advanced pricing agreements, and contemporaneous documentation studies. His extensive transfer pricing experience includes cost-sharing agreements, transfer of tangible and intangible property, intercompany service, intercompany loans and guarantees, amongst others. Maulik is a frequent speaker on various international platforms, and his articles are published in various international journals. Over to you, Maulik.
Thank you, Kate. Good morning, everyone. I welcome you to this webinar on the evolving transfer pricing landscape in India. Transfer pricing has never been a dull subject in India. Right since its inception in 2001, 2002, we have seen kind of virtually everything on transfer pricing. And yet, as we go by, day in and day out, the regulations and the government keeps on surprising us with newer frontiers to look at. What we're going to cover today is broadly in terms of what were the significant changes that has taken place over the last 6 months to a 12-month period, how those significant changes are going to affect the businesses doing in India. And most importantly, we're going to cover the new transfer pricing documentation requirement that got kicked in just a fortnight before, where the Indian government has kind of pronounced new rules for maintaining transfer pricing documentation. So we're going to kind of go through a little bit in details in terms of what this new transfer pricing documentation entails. And obviously we'll end up with what are the key takeaways for businesses in India. So, like I mentioned, 2001 was the inception year for transfer pricing, and we saw transfer pricing being introduced pretty much similar to the OECD model. So, the guidance, the transfer pricing regulations in India were inspired from the OECD guidelines, though we had our own variations. So, when the transfer pricing regulations were introduced, there was a joke going around saying that India has taken the meanest provisions from all other countries and put it in the Indian transfer pricing regulations to come out with what Indian multinationals and foreign multinationals in India would have to face. So that was the introduction of transfer pricing, and the first decade or so we saw a lot of learnings. There was a aggressive transfer pricing administration in India. They were trying to kind of navigate through this regime. They were trying to bring concepts which were borrowed from international jurisprudence, from the Australian tax office, from the US IRS, from various other tax authorities, and trying to see how they capture the and ensure that the tax base in India is not kind of violated. So that the decade period from 2002 to 2012 was more like a learning experience. We saw a significant amount of adjustments being done. In fact, I still remember almost every survey that is being done with CFOs across the globe. Generally, they put transfer pricing as the #1 tax worry, and India and China to be the most aggressive tax jurisdictions amongst all other jurisdictions. So That was the extent to which the Indian administration had gone by. 2012 is for the first time that the government had realized that they're going a little bit too aggressive and too far in implementing transfer pricing regulations, and they need to kind of take some corrective steps to kind of ensure that the investor confidence is there in the country and they get continuous FDI inflows. So for the first time, they introduced two dispute resolution mechanisms. One was the advanced pricing agreement, and other was a safe harbor. And these regulations, while they were introduced with an objective of reducing litigation and disputes in India, it didn't help the initial period. Although APA program later on went up to be a very successful program, and we'll discuss that in detail a little bit more towards the end of the webinar. In 2012, we also saw domestic transfer pricing being introduced. So the 2001 introduction was only related to cross-border transactions, but the government by 2012 realized that there are many companies in India who are not paying the full tax rates, and there are opportunities within the groups within India to plan their tax affairs in a manner that they shift the profits from one entity to other entity and reduce the overall tax burden. So they introduced the provisions of domestic transfer pricing, thereby requiring even transactions between Indian related parties domestically to be subject to transfer pricing. The next line of alignment came in 2015 and 2016, where essentially we started aligning ourselves with global regulations. So as I said, when 2002 regulations were introduced, it was more like choosing the meanest provisions across the world. But in 2015, we realized that we need to align ourselves more with the OECD guidelines and with what other developed countries in the world are. So we kind of introduced what is called the range concept, which is prevalent almost entirely in USA, in UK, in European Union. And we also kind of introduced the use of multiple year data. Again, that's quite common in the other nations. But believe me, till 2015, those two concepts were alien in India. The tax officers and the tax authorities would never entertain multiple year data to benchmark transactions, or they would never look at a median or a interquartile range to benchmark the intercompany transactions. So those two major steps were kind of partially responsible for reducing further litigation. And at the same time, in 2016, early 2016, government introduced what is called as a risk-based criteria for selecting the cases for detailed audit. This was a major deviation from what was the position earlier, and this one step alone has reduced transfer pricing litigation by more than 50 to 60%. So where any entity doing businesses in India with their related parties with a significant amount of turnover or related party transaction used to get picked up. Now the government has introduced more like risk-based criteria where they look at various parameters, not only the thresholds or the volume, but other parameters, and based on which they kind of select the case for scrutiny. So I remember a time where we at SKP were handling almost 50 to 60 transfer pricing scrutinies on an annual basis, where a lot of our clients used to get picked up for a detailed audit. But over the last 1 year or so, there is a significant reduction in that. In fact, we see all the small and medium-sized enterprises getting immensely benefited with this easing of transfer pricing scrutiny norms. 2017 saw a lot of rationalization again. So it was an alignment with the BEPS Action Plan on the base erosion and profit shifting project of the OECD. So we introduced the detailed transfer pricing documentation in line with the BEPS Action Plan 13. We introduced the concept of secondary adjustments, and our safe harbor regulations were kind of rationalized to bring it in more line with the expectations that the industry was having. And we are going to discuss some of this again in the later part of this webinar. So it's been a very interesting journey on transfer pricing side. I would say that I kind of virtually seen it all. The issues that were prevalent in the Western world, in the developed economies like US, the same issues were kind of replicated in India. So both the taxpayers as well as the tax authorities and professionals like us got an experience in terms of how to deal with those issues. So it's been a very interesting journey on the transfer pricing side, and with the new transfer pricing documentation that has been unveiled, I think that is the new journey is going to start. It's a start of the new era on the transfer pricing side, and we need to see how the next decade or two goes on transfer pricing. This was a chart showing the amount of litigation and the amount of adjustments that were done over the years. So if you see, consciously after 2012 there was an effort from the government to reduce the litigation, and that gets depicted in the chart in terms of the quantum of adjustments getting down. There are three reasons for the reduction in litigation. A is the past aggressive position that the tax authorities were taking, say in 2008 or 2009, that did not get any favorable response from the Indian judiciary. A lot of cases were disposed of by the judiciary in the favor of the taxpayer, and the tax authorities were not able to sustain their positions, and therefore they started realizing that the aggressive positions that they are taking in the tax assessment order is only harming the economy and not doing any good. And that's why we see a rationalization both in the approach of the tax officer as well as in the overall reduction in the number of cases that are selected for scrutiny. Some of the critical transfer pricing issues that are relevant even today, and this have been kind of built up over the years. Marketing intangible, I think, tops the chart. Simplistically putting, if an Indian company, which is a subsidiary of a German parent, either doing a manufacturing activity or a distribution activity, incurs a heavy advertising expenditure, maybe with an objective to penetrate the market, create brand name, goodwill in the Indian market, whatever would there be that objective. What the tax authorities contend here is that if there is an excess spend on the advertising, marketing, and promotion, and they define this excess as excess over to other comparable companies or over other similar distributors or manufacturers in India, this excess, they say, is actually building up the brand for the group in India. The brand economically and legally is owned by the parent company in Germany. The Indian company does not get benefited by the increase in brand value, and therefore, since it is a benefit to the parent company should pay Indian company for the higher brand value that it is commanding in Indian region because of the excessive spend that the Indian company did on advertising, marketing, or promotion. So the position they have is that any excess of advertising, marketing, and promotion expenditure is more towards enhancing the brand for the parent company, and the Indian company should not pay for it but should get remunerated or compensated by the parent company. The typical marketing subsidiaries in India or the typical companies in India who are doing procurement on behalf of the foreign company, they are facing an issue vis-a-vis their remuneration model. Most entities operate on a cost plus basis. It could be cost plus 10%, 12%, 15%, or even 20%. The tax authorities are not happy with that. What they are looking at is that if the Indian company is procuring goods on behalf of the German parent, this procurement function, depending on the intensity of the function, in the sense that the Indian company does it do the supervisory activity, does it do the quality check, does it do the negotiation with the vendors. So depending on the exact activity of the Indian company, they believe that this procurement activity should be remunerated with a percentage of commission, so as a percentage of the total goods procured on behalf of the parent company, and that generally tends to turn out to be much higher than the cost plus remuneration that the Indian company gets. So their contention is that rather than a cost plus simplistic model, the Indian company should get 4%, 5%, 7% commission, again depending on the exact functions being performed by the Indian company. The IT back office service providers were kind of the most affected in the first decade of the transfer pricing. So right from 2004 to 2012, the IT service providers were kind of very badly affected. Generally, they get remunerated on cost plus 15% basis, but the Indian tax authorities, by looking at the comparable companies that are prevalent in India, and obviously there is some element of cherry picking there also, would tend to say that the margin for a IT back office or a software development back office in India should be anything between 20 to 30%. And that's where most IT companies were battling with the Indian tax authorities. And most of the companies were able to kind of have a better chance at the tax tribunal level or the appellate level, and most of them were successful at a higher appeal levels. So the issue is kind of more or less getting settled, where even the safe harbor, the device safe harbors are much more rationalized, and the APAs are being signed on this side to be in the range of between 15 to 17%. So the markup expectations are becoming more rationalized in respect of captive service providers. In respect of inbound and outbound corporate guarantees, the tax officers really realize that whether the Indian company who is giving guarantee abroad is charging the right guarantee fee, and if yes, what should be the quantum of such guarantee fee. That is where there's most of the litigation and dispute, where the tax authorities in India expect the Indian company going outbound to charge anything between 3 to 5% as the corporate guarantee charges, whereas the arm's length prime equivalent would be half a percentage points or 25 basis point. The last is the intra-group services and royalty payments. These are the most challenging. This, I believe, still remains one of the most litigious area. Any Indian company making payments towards royalty or for management fee or corporate headquarter charges or whatever name we call it, essentially is facing this issue. The issue for them is whether the Indian company is receiving commensurate benefits that are in line with the payments that they are making, and the tax authorities require very extensive documentation to justify and prove that the benefits have been received by the Indian company. So the revenue authorities challenge both the receipt of the services or technology and the commensurate benefits that are being received, and therefore still I believe that this is the most litigious area, where almost 8 out of 10 countries, 8 out of 10 companies would be facing an issue on making while making royalty payments or intra-group service payments, and the tax authorities require an extensive documentation. So those were the critical issues, and as I said, like the litigation chart in India was always rising. India was regarded as one of the most aggressive jurisdictions, and this was obviously not going down with foreign investors who want to do businesses with India. And therefore, in 2012, government came out with the program on advanced pricing agreements. Well, this APAs are being prevalent in most of the developed nations. It's there in almost all the European Union countries. It's there in UK. It's there in USA. It's there in Japan, Singapore, Malaysia. So kind of it's there almost across the world where transfer pricing exists. India introduced it a little bit late, almost a decade after the transfer pricing regulations, because it wanted to test how transfer pricing works and how APA program would work. So APA has been kind of by APA we mean that you get into an agreement with the tax authorities on the proposed pricing methodology or proposed pricing of the intercompany transactions. And once you enter and negotiate that agreement with the tax authorities, that's fixed for a period of 5 years, and essentially there's certainty to the taxpayer. There is no question of litigation from the tax authorities, as long as all the critical assumptions which were laid down while agreeing on the pricing policy are being fulfilled. So it's a very good avenue for getting certainty and kind of avoiding litigation in India. Because of this fact, we saw almost 800 plus applications or APA applications being made. So the very fact that there was a very high litigation in India, compounded with such a nice program, I think encouraged the taxpayers to go in for the APAs. APAs are of broadly two types: unilateral and bilateral. Under the unilateral APA, the Indian company enters into a pricing agreement with the government of India in respect of an intercompany transaction. Whereas in a bilateral, it's a dual thing, where the Indian company, the German company, the German tax authorities and Indian tax authorities would get together to discuss a bilateral APA. Unfortunately, India-German tax treaty, as it stands currently, do not allow for a bilateral APA. So as things stands, the bilateral APA is not there for German companies operating in India. It is mainly for it is mainly that they can seek the redressal in form of a unilateral APA. APAs, as I said, 800 plus APAs were filed, almost 185 being concluded in till now. Uh, yes, the backlog is quite huge, but the speed at which the Indian tax authorities are disposing APA is fastest amongst the world. We have not seen any other tax authority across the globe having quicker disposals than the Indian tax authorities. The team at the on the ground which are looking at the APA is very pragmatic, very business friendly. So the experience of the taxpayers who have concluded the APAs has been extremely wonderful. They feel that rather than kind of defending their positions before the tax officer who may or may not be able to appreciate the business realities, the APA team is in a better position to understand those business realities and make amends accordingly. And therefore, the APA program has been quite successful. I'm not going to go through this. It's quite there are some statistics in terms of the number of applications that have been filed over the years. As I said, the bunch of applications were filed in the second and the third years. Once the tax authorities and the taxpayers saw the outcomes of the APA and gained confidence in the entire program. But if any company is facing litigation in India, or they feel that their transactions in India are going to be challenged by the tax authorities, I would certainly recommend for them to explore the APA option, because it's a very good effective litigation tool to kind of avoid litigation, to manage the dispute. And the advantage of Indian APA is that it not only provides a certainty for the going forward 5 years, but if you had a litigation in the past and at the option of the taxpayer, you can kind of roll back the APA for the past 4 years. So in a sense, through one process of the APA, you can get a certainty for 9 years. The rollback is at the option of the taxpayer whether he wants to kind of roll back the agreed APA for the past 4 years, in which if there are litigations that are pending. The other aspect is in respect of safe harbor rules, and these are again were introduced in the year 2013. Essentially, by safe harbor, one means that for certain sectors and for certain types of transactions, the government have defined what could be the markup expectations or what could be the profitability expectations. And if the taxpayer is able to declare that markup and profitability, then there is no litigation that is further there. Though introduced in 2013, the safe harbor provisions got very little response because the expectations of the markup and the margin were very high. So for a captive software development or IT enabled services, the markup that was expected was between 20 and 22 percentage. For a KPO unit, it was 25 percentage. For research and development services, it was almost 29-30 percentage. So because of such a high value, high markup percentages, the safe harbor provisions were not being kind of looked at by many multinationals. Therefore, the government felt the need to rationalize that. So in 2017, the government rationalized the percentages. Some of these percentages are in line with what the APAs the government had signed with some in some of the sectors. So for software development and IT enable, the government have kind of come down with from the 20-22% markup to a 17-18% markup. For the KPO, the markup ranges between 18 to 24% depending on the type of KPO you are. So they will essentially take the employee cost as a parameter to determine what kind of KPO activities you are doing. For research and development activities, it came down to 24% from the 29-30% range. So in a sense, an excellent move by the government again to help small and mid-sized enterprises. At the same time, what the government has done is that for availing safe harbor, they have put a cap of 31 million US dollars of the transaction value. So if the intercompany transaction is more than 31 million US dollars, they cannot opt for the safe harbor. So essentially, it is meant for small and mid-sized enterprises doing businesses in India. One very interesting development that has taken place in safe harbor is the introduction of a new category of safe harbor regulations for low value intra-group services. Essentially, if the Indian company is receiving any management fee charge or management services from the headquartered company, which are kind of routine support services, not anything on the technical, on the value added side, but more on the routine support services like accounting or HR support or IT support or legal support. If these are on the nature of routine support services, and if the value is less than 10 million INR, then they can opt for the low value intragroup services safe harbor, where the German company, if it has charged the Indian company either on a cost to cost basis or up to cost plus 5%, and if the nature of services are routine support services, they can opt for safe harbor, and there will be no questions asked by the Indian tax authorities further. So the onerous requirement of having detailed documentation on the benefit test goes away with the revised safe harbor, and the company can opt for safe harbor if they are below the threshold that have been defined. So essentially, the implication of the reduced safe harbor is that it's a great tool for small and mid-sized enterprises to take benefit from this. The tax authorities will now concentrate on high-value transactions, complex transactions, considering the fact that a lot of small value transactions do not yield so much of revenue for the government. Offering the or getting the new bracket of low value intragroup services is again a commitment of India to follow the action plan 8 to 10 of the BEPS action plan. So they are moving in line with the OECD BEPS action plan, and one needs to kind of carefully study whether their activities and enterprise in India is eligible for safe harbor, and if they are eligible for safe harbor, do a cost benefit analysis in terms of if there are any higher taxes to be paid because of safe harbor vis-a-vis the savings in the litigation cost in the future, and then accordingly can opt for safe harbor regulations. Another concept that was being introduced by India was secondary adjustment. So there was a very interesting phenomena where since the Indian tax authorities were very litigious, most of the companies used to kind of tend to be on a conservative side. They want to be erring on the side of caution, and therefore they used to say that okay, while our group policy is cost plus 10% for a marketing subsidiary in India, since the Indian tax authorities are going to be extremely aggressive, I don't want to get into the litigation mode. So let's kind of have a cost plus 20%. But since it is very difficult to change the group policy, the additional 10% is what we pay tax on here in India without making adjustment to the books. So the books of accounts reflected a cost plus 10%, but the taxpayer, in order to not to litigate further, used to pay additional taxes on the balance 10%, taking it to cost plus 20%, and therefore avoiding the scrutiny, at the same time meeting with the group requirement. Now they had some implications from a government's perspective, because the additional 10% did not flow into India in terms of foreign exchange. Neither it was recorded in the books of accounts, and therefore there was no question of there being additional dividend distribution taxes, etc. on that. And therefore government realized that that kind of suo motu adjustment in the tax return, not recording the books of accounts, should not be allowed, and therefore they brought in the secondary adjustment concept from financial year 16-17, saying that if there is a suo motu adjustment in the return of income, or if there's an if the pricing agreed under the APA or a mutual agreement process or a safe harbor is higher than what is recorded in the books of accounts, or if the tax officer makes an adjustment and the taxpayer does not prefer an appeal to that. So in essence, as long as there is a difference between the price at which the tax is paid, the arm's length price under which the tax is paid, and the price booked in the accounts, one needs to do a secondary adjustment in respect of such differences. So essentially, in the example that I was talking about, say if the Indian entity was doing a cost plus 10% model, and now we are moving to cost plus 20%, the difference 10% needs to be recorded in the books of accounts, and the foreign company needs to repatriate that money within a specified time. They have provided 90 days from the as a time limit from the date of filing the return of income, and if the foreign company fails to remit the money to the Indian company, then the Indian company would have to pay taxes on a notional interest basis, based on the rates prescribed. So if there is a delay beyond 90 days of getting the money in the Indian company, then the Indian company would have to pay a rate of almost LIBOR plus 300 basis point if it's a foreign currency billing, or a marginal cost of funds for the Indian State Bank lending rate plus 325 basis point if it's an Indian rupee billing. So essentially, the government is trying to say that there cannot be any differences between the tax arm's length price and the arm's length price recorded in the books of accounts, both needs to be one and the same. And if there is an adjustment on account of transfer pricing, the adjustment needs to be recorded in the books of accounts, and the foreign company needs to repatriate the funds within the time limits prescribed. Essentially, this was the same case study that I kind of took it as an example, so we need not go through that. But any company which has similar kind of an issue, in the sense the companies which were making such suo motu adjustments in the tax returns in the past, will now to reevaluate that position and see how they can fit under the secondary adjustment, and how they can ensure that they comply with the new regulations that are being prescribed. So that were some of the developments that have taken place in the transfer pricing regime from an Indian statute perspective. Coming to some other developments which are more in line with the OECD BEPS Action Plan. So I'm sure all the listeners here would be aware of the OECD BEPS Action Plan, and I do not want to go into that because that itself is a separate topic for a separate webinar. But essentially, OECD along with the G20 countries had formed a committee to look at how base erosion and profit shifting done by multinationals can be plugged in, and how different action points can be taken in order to ensure that such base erosion and profit shifting does not take place. Some of the action plans were laid down in October 2015, and India has accepted most of those recommendations or action plans and have brought them into the Indian statute. One such action plan is Action Plan 4, which talks about limiting interest deduction. So essentially, in the pre-BEPS era, as I would say, there was a lot of tax planning being done through funding structures where the subsidiaries were funded through a higher debt portion and a very low equity portion, and taking the interest out of the subsidiary being a tax deductible expenditure. Now, from financial year 17-18 onwards, they have said that it's any Indian company that makes payment of interest to a non-resident parent company or a group company, if the interest is beyond 30% of the EBITDA, then such excess interest would not be allowed under the year under consideration, but would be allowed to be carried forward up to a subsequent period of 8 years. So essentially, every company needs to check their interest payments to associated enterprise, whether they are within the 30% EBITDA or not. If it goes beyond 30% EBITDA, the excess portion would be disallowed. Now, when they brought in the regulation, they were mindful of the fact that it could be in the form of interest paid to an associated enterprise, or it could be interest paid to any other unrelated party, provided that the loan from that unrelated party is backed up by either an implicit or an explicit guarantee from the parent company or the group company. So if I take an example, let's say if a German company operating in India through a subsidiary, let's say they have set up a manufacturing plant in India. Now, instead of borrowing from the parent company, the Indian subsidiary has borrowed from Deutsche Bank India based on the corporate guarantee given by the German parent. So while the Indian company, the payment of interest to an unrelated party, but the fact that it is backed by a corporate guarantee from the parent company, it would be kind of regarded as a intercompany debt itself, and therefore any interest payment to Deutsche Bank India would have to fulfill the criteria in sense that it should not exceed the 30% of the EBITDA. If it exceeds 30% EBITDA, then the interest should be disallowed and carried forward up to a period of 8 years. So kind of they've put down that in form of some examples. Where, so example, very first example, what we are trying to say is that if the Indian company's EBITDA is 100 and the total interest paid is 40, which out of which 15 is paid to AE and 25 pays to non-AE, up to 30% of the EBITDA would be allowed. So the excess interest is 10. The interest paid to AE is 15. So the excess interest of 10 would be disallowed and would be carried forward subsequently. Similarly, in the scenario 4, where the Indian company is loss making, again there would be challenges because any interest payment would be falling short of the 30% EBITDA, and the entire interest payment to associated enterprises, or in respect of a loan where associated enterprise is is backing through a corporate guarantee would be able to defend that. So in that sense, one needs to kind of look at their funding arrangements now and see how they need to come out of this provision. It's going to kind of affect all the startup companies, all the companies into manufacturing space who have huge capital expenditure and huge borrowings, and therefore they need to look at their funding patterns and whether they fulfill the 30% EBITDA criteria or not. Uh, India also adopted Action Plan 8 to 10, where basically the BEPS Action Plan talks about aligning the value creation with the economic activity that is being done in the entity, and therefore there's there will be an extreme focus on terms of the actual activity being done in India, what kind of value creation the Indian activity is doing, sorry, the Indian entity is doing, and whether the remuneration policy is in line with such value creation and economic activity done in India. And therefore, the high-end research and development centers here in India, or the limited risk distributors, or distributors having higher marketing spend, they need to relook at their intercompany pricing and strategies to ensure that they are in line with the OECD Action Plan 8 to 10, and where the value creation is in line with the economic activity, and both of them are in line with the pricing policy that is being decided. So while there is no specific change in the Indian regulations, by and large the tax authorities approach would be towards this new Action Plan 8 to 10. Coming to the last bit of one of the major changes that have taken place is in respect of the enhanced transparency documentation requirement. So from financial year 16-17, that is for the year starting 1st April 2016, the Indian company would have to have a detailed transfer pricing documentation. The documentation is in line with Action Plan 13 of the OECD, and most even Germany and other European nations has adopted this Action Plan 13. Action Plan 13 talks about three-tier documentation, and therefore the Indian regulations also talk about the three-tier documentation. The first is a local file. A local country file is a similar transfer documentation that your Indian subsidiary would have been maintaining for all these years, right from 2001, since the Indian regulations were introduced. No changes in that. This is to be prepared for each local entity in India on an annual basis and to be submitted to the tax authorities as and when asked for. The second is a master file, where there is a requirement at a group level to prepare the master file. It contains high-level blueprint of the multinational group global operations, talks about supply chain, talks about intangibles, group financing, what are the value drivers for the business and the industry. Essentially, master file is being prepared centrally at the headquarters and has to be submitted with the tax authorities in all the countries where the group operates. And mostly our experience is that it's been prepared at the headquarter level. Where a master file is applicable, we'll come to that. The third level is the country by country report. Essentially, this is again in line with OECD BEPS Action Plan 13, where multinationals having a turnover of more than 750 million euros would have to prepare a country by country report, and the headquartered company would have to file it with the tax authorities. This country by country report would then be exchanged by the resident tax authority with all other tax authorities across the world under an automatic exchange of information. The country by country report essentially contains summary of the economic activity of the group. It basically is a simple Excel sheet providing all the group companies, all the locations, and some of the very important economic parameters like the sales, profit before taxes, profit after taxes, the taxes paid, the number of employees, assets, intangibles, all those things would be reflected in the country by country report. As I mentioned, country by country is applicable only if the consolidated turnover is more than 750 million euros. So coming to the most important element, the master file. The master file is applicable if the consolidated group turnover is more than 65 million euros. The threshold is much lower in India as compared to some of the other developed countries. So any group that is operating in India which has a consolidated group turnover of more than 65 million euros and the aggregate value of intercompany transactions with India more than 6.5 million euros or more than 1.3 million euros in respect of intangible transactions will have to prepare the master file. The first master file would have to prepare for the financial year 16-17, and the due date for submitting that to the tax authority is 31st March 2018. As I said, the master file contains the organizational structures, the description of group businesses, the important profit drivers, intangible property, intercompany financial activities, the functional asset and risk analysis, the FAR analysis of the key group entities, description of the supply chain, and group financial and tax position. So these are very important elements of master file. Now, one very important aspect to be understood is the master file requirement in India are slightly different from what the OECD has prescribed. While we have taken more or less everything from the OECD, India has prescribed 3 or 4 elements more in detail under the master file requirements. So while master file preparation would have to be done at the headquarter level, the Indian master file would have to be customized to a little extent before submitting it to the Indian tax authorities. The customization mainly is the Indian master file talks about requirement for a function assets and risk analysis of key group entities, which is not there in the OECD prescribed guidelines, and there are further few details that are required from an Indian perspective. So very important to understand for the German companies who are operating in India and who are crossing this threshold, that while they may prepare a master file based in Germany with the German team, it has to be slightly customized from Indian purposes before submitting it to the Indian tax authorities. The country by country report, the threshold is 750 million euros, so that's a quite high threshold, and which has been prescribed mainly by OECD, and India has followed that. The first due date is 31st March 2018 for the financial year 16-17. The due dates for this year were extended to March 18 because it's a new provision, and companies need a little bit more time to gear up themselves to prepare this. From next year onwards, all these due dates would be due dates of filing tax return, which in India is 30th of November 2017. In respect of country by country report, if the group is crossing the threshold, the Indian subsidiary would have to intimate the Indian tax authorities that the group entity located in so and so country has prepared the country by country report and is filing with its home country tax authorities. That intimation has to be done by the Indian tax authority, by the Indian company to the Indian tax authority before 31st January 2018. So what is the implication of such enhanced transfer pricing documentation requirement? The entire global picture will now be before the tax authorities. So that definitely would lead to more questioning, detailed inquiries at the time of audit. As I mentioned, this is a new requirement. So migrating from the current level of transfer pricing documentation to the new requirement is challenging. It would be daunting in the initial years, and the companies would have to gear themselves up to such a high level of documentation and additional details that needs to be presented. Master file requirement, while it can be prepared at the headquarter level, like India has done some customization, other countries like China, Japan, Singapore, everyone has done some kind of customization in their master file requirement. So the headquarter essentially would have to kind of rework and ensure that the customizations in the local rules are being adhered to. There will be obviously uncertainties with additional flow of information and additional information being available to the tax authorities, and these additional disclosures would not only lead to transfer pricing disputes, but it would lead to additional questioning from a permanent establishment perspective, from a withholding tax perspective, from any other tax treaty benefits or anti-abuse perspective. So in essence, it would be a difficult time to face the tax authorities with such a additional and such a high level of information being available to them. And countries such as India, where the numbers in terms of the market size or human resources are quite large, this would be a burdensome exercise, definitely. Obviously, there are some positives out of it. It depends on the way you look at it. But this preparation of master file and country by country report also provides an opportunity to streamline your transfer pricing policies, processes, and documentation across all entities across the globe. It's an optimization for there's opportunity for tax optimization if there are any current leakages. It brings in our efficiency and avoids duplication. Uh, the documentation would help defending the cases before the tax authorities, be it India or anywhere in the world. And I'm sure the documentation in the country by country report would provide some strategic inputs to the business for making some strategic decisions also. So it's not that everything is burdensome or everything is negative. There are some positives to it, and if the company honestly works towards maintaining this kind of documentation, this would really be helpful. As I mentioned, contract R&D, captive service providers, royalty being paid by the company would be more questioned under the new norms, because whether the company that is receiving the royalty, what kind of functions it is undertaken to develop the technology would be questioned. That information would be available to the tax authorities. What kind of R&D expenditure is being incurred would be available to tax authorities. So all in all, any business arrangement, any business transactions with India, there will be a completely new perspective to look at it, because a lot more information is now at the disposal of the tax authorities, and the tax authorities are kind of much more powerful. They have an important tool, and they are in a better position to assess the taxes and the transfer pricing policies of multinationals operating in India. The companies need to start preparing themselves. They need to kind of map their global operations and the transfer pricing requirements in each and every country. They determine whether country by country report or master file applicability is there in each of the entities. They need to kind of within the group clearly define the roles and responsibilities in terms of flow of information, in terms of submitting it to the tax authorities, in terms of, in essence, to prepare themselves to comply with the new requirement. Obviously they need to undertake a gap analysis in terms of what information they have and what further information they will be required in order to kind of meet with the requirements, and try and see how their systems can be geared up to ensure that the additional information that is required comes out of the system. uh, One has to monitor on a real-time basis the information flow and the details that are being gathered, and obviously have a calendar for all the compliances in terms of documentation, benchmarking searches, and the local compliances in all the countries. So essentially, it's a task that is there for multinationals, where they need to gear their transfer pricing teams to cope with the new requirements on the transfer pricing documentation side. A few tips that I can kind of pass it on, having worked with many companies on these projects. It's very important, first of all, to educate the group entities, to educate the finance team and the tax teams in all the group entities that this is a requirement. We have come across many times where the Indian CFOs or the Indian tax manager does not know that the German parent has already prepared something like a country by country report or a master file, and we sometimes realize that many companies reinvent the wheel in each and every jurisdiction. So education and passing on the information is very important. uh, Performing a what if analysis on the potential questions, inquiries from the tax authorities would be very important. So once the entire information is available, it is very important to analyze that information and gear up ourselves for the scrutiny from the tax authorities. Put down all the questions that would come from tax authorities and try and have documentation and answers to those things. Have a system to gather real-time evidences and real-time documentation, especially that will help in justifying it before the tax authorities and defending it before the tax authorities. There should be a system of communication between the business team and the tax team. We realize that there is a big communication gap, where most of the times business teams would go ahead and kind of entirely do a transaction, and the tax team comes to know of it much later, and therefore the tax team thereafter would have to struggle with the information and documentation, and have a very harmonized picture for the master file, the country by country report, and the local files, and try and have achieve a balance. I know the balance is very difficult, but try and achieve a balance between what information needs to be included in this documentation requirement vis-a-vis the business information that need not go out. So all in all, one needs to be kind of be ready for this. Technology obviously would be useful. It may not be of that much use in the initial years, because one needs to set the processes and systems in place. But in future years, once things become a little bit more standard, technology would definitely be much more useful. Tax and business operation team should work in sync on this aspect, and at the same time evaluate the advanced pricing agreements and the other dispute resolution mechanisms that are available. So essentially, don't look at transfer pricing documentation as a data-driven exercise. It's more like storytelling, where the group needs to tell its story in such a manner that the tax officer buys it, and you are able to defend the matter before the tax authorities. So that's something on the new transfer pricing documentation requirement. To sum up the webinar in the last 1 minute or so, with all the developments that are taking place both in the tax and the transfer pricing arena, one needs to kind of relook at their group structures and group pricing policies. It's very important to have a tax efficient transfer pricing policy for the group as a whole, and ensure that the policy is well implemented and monitored on a real time basis. There needs to be a coherence between the compliances in the local laws and compliances that are globally there, and the documentation would be the key to defend your transfer pricing policies, and therefore timely collation of documentation would be very critical. I think with that last comments, I would like to wrap up the webinar. We are kind of more than happy to take up if there are any questions on this side. We'll be addressing them right now. We have another 5 to 7 minutes to address those questions, and if there are any questions after that, you can feel free to write to us also.
If you have any questions for Maulik, please feel free to type them into the question box, and he'll get back to you.
We have one question in form of on the master file requirement, which talks about how should a German company deal with the master file requirement if it's crossing the threshold limits. As I mentioned, the master file requirement, if the Indian company is crossing the threshold limits, then the due date for filing the master file is 31st March 2018. So one needs to kind of ensure that the master file is being submitted to the tax authorities before 31st March 2018. The master file that would have been prepared at a group level, at the headquarter level, would be a very good starting point. In fact, I would say 80 to 90% of that would be good to kind of adopt it in India. It's just that the Indian tax, the Indian format is slightly different, and therefore there will be some customization that would be required at the Indian end. And there, the recommendation would be to only customize it for India and not do any customization at the group level, because the same master file which is prepared at the group level would have to be kind of submitted to tax authorities worldwide. And it's, in my view, customizing Indian master file would be much more appropriate rather than customizing the group one. So once the Indian company has the group master file with it, it can incorporate the additional details which are there from the Indian law, and prepare the Indian customized version which can be submitted to the tax authorities. But yeah, the time is of essence, because 31st March 2018 is the deadline to file the master file, and considering December time period and Christmas holidays and everything, there is hardly any time left to do these compliances.
Thank you, Maulik, for sharing these insights with us. We thank our listeners for the overwhelming response. If you have any other questions, or if you would like to get in touch with Maulik, you can write to us at skp.tax@skpgroup.com, and we'll be sure to connect you with him. Do log on to our website, www.skpgroup.com, to know more about us and to see how we can help you best. Thank you.